welcome to the CNBC TV 18 special. I'm Shireen Bhan and we're coming to you from the St. Petersburg International Economic Forum. It's almost the Davos of this part of the world. The World Economic Forum hosts the annual meeting in Davos, and this is the economic forum that's been meeting here in St. Petersburg for a very long time. Now, the conversation here focused around the rise of protectionism, on what President Trump and his trade war is going to do, and of course Russia itself, the economic sanctions against Russia, and what impact that could have, even though the economy is rebounding on account of commodity prices. To discuss all of that and more, we have somebody here who knows the region, who knows India and China specifically. Andy Shea, appreciate you joining us here on CNBC TV 18. As I started off by saying, the conversation here being dominated by Trump and the US-China trade war, or the possibility of a trade war, and of course Russia itself. But let me start by asking you about the US and China. You've written in the past saying that it's almost like two fighters in a kung fu novel. So what do you make of it?
So far, it's really shadow boxing. Still, the United States doesn't know what to do yet. I don't believe that a trade war will happen soon, because Chinese products are not exactly Chinese products. They are American products and branded by American companies. So the United States hasn't figured out what to do yet.
Okay.
But still, there is an issue that the U.S.-China trade imbalance is expanding.
Yes.
And I think that the frustration will build. I think that in a couple of years' time, maybe something more serious will happen. But so far, it's mostly noise.
It's mostly noise and mostly tweets is what you believe.
Yeah.
But you do think that China should offer some concessions to get President Trump to back off?
Yeah, I think China is trying to buy a lot more energy products, even though buying agriculture products, it's politically it's important for Trump and for the Republican Party. But it's the amount of value is not there. It's you cannot make up for the current imbalance. But the energy is possible. China needs a lot of energy imports. So China will be buying a lot more, but it's going to impact other countries like Russia, like Saudi Arabia, and so forth. But a lot of Americans are not happy about being a commodity producer. The United States is technology and a manufacturing economy. They don't want to be relegated to a commodity economy. So I think that buying energy alone is not going to solve the problem. It's going to maybe postpone the confrontation a couple more years.
So if you believe that today we're not really faced with a serious threat of a trade war, and that both sides are calling each other's bluff quite literally, what do you see happening in the short term?
Well, I think short term is really the market risk premium is rising. The financial markets have been very buoyant for many years.
You believe that valuations have shot far
it's
ahead
100% above historical average. So there is a big bubble. There is a big internet bubble. I don't know what from economic data, we don't see the contribution from those companies to the global economy, right? But they're getting so much attention. Valuation is just extraordinary. There is a big bubble in the financial markets. So the risk premium is rising. So there's a threat there.
But, a lot of people have been saying that valuations have run up and we are likely to see a crash, so to speak, or at least a significant correction. Do you believe that, but the markets haven't corrected at all?
The interest rate is still negative.
Yeah, but given what we just heard from the Fed in the Fed meeting and the Fed minutes, do you believe that, we are likely to see the markets continue in this current momentum, even though the valuations are out of sync with reality?
I think the market is already in range bound. It's not a crash. But I think the uptrend is being stopped. The U.S. interest rate is now below inflation, still slightly, real interest rate is still slightly negative, but there is expectation that the interest rate will rise and real interest rate will become positive. So I think it's very difficult for a market at such a variation to move up when the real interest rate is turning positive. And with the risk premium rising with the trade war talk. So I think that the market will struggle. But the crash is not yet because the economy is still doing well.
Right.
Real interest rate is not exactly going to 2 or 3%. It's still kind of close to zero. So the market will be range bound for a while.
Okay, you believe the markets will be range bound. You talked about interest rates moving higher. That's the anticipation. We're here in Russia where the commodity cycle uptick has certainly helped these economies. Currency and currency volatility and currency fluctuation, especially emerging market currencies. I mean, what will be the triggers that you're going to be watching out for from a macro perspective, global macro perspective?
I think some countries that are really, during the super low interest rate period after 2008, during these 10 years, some countries did build up a lot of debts. Like Argentina is an example, right? So I think some emerging economies may get into trouble. But overall, I don't see that another emerging market blow up like in 10 years ago or even 20 years ago. But most emerging economies have substantial foreign exchange reserves, so I don't see that. I think the next crisis will again come from developed economies. We see debt levels are really high. The U.S. economy is at a cycle peak, but they are running $1 trillion fiscal deficit. Interest rate is still so low. When the economy turns down, how are they going to prop up the economy? So I see the next crisis will come from developed economies like the United States. Even Europe, the levels, debt levels are very, very high.
Let me turn our attention to India now. And you've been a long-time tracker of India. In fact, I remember reading, you said that 17 years ago, the Indian government had invited you, asking you for advice on what it should do. And your advice was invest, invest, invest.
That's right.
Today we're almost at the 4-year anniversary of the Modi government. How would you rate India?
Well, infrastructure investment has picked up some. I think that India is making progress, but the pickup is insufficient to meet the ambition that the Modi government has. The Modi government wants India to have a 10% growth rate, maybe and a double income like in 7 or 8 years and so.
You believe that that's not a realistic aspiration or target?
I think you look at what China did after 1998. The ramp up in infrastructure was much quicker. You look at the highway, highway investment started in 1998. They started in like 1,500 kilometers per year, then built up very quickly to like 6,000 and 10,000 per year. That kind of scale is what India needs if you wanted the economy to become to have a 10% growth rate. The key to fast growth is to turn labor into capital, and there's been too much emphasis on consumer consumption, consumer credit. I think that you can juice up the economy with consumer credit in the short term, but if you have a sustained long-term growth rate, you must make people to work for creating capital, like building cities, building infrastructure. Then they get paid. Then eventually they use the money they earned to buy the property they built. So that's the virtuous cycle of turning labor into capital. That's for a large economy like India that needs to build up its asset base massively. That's what it should do.
Do you believe that the infrastructure deficit is also linked to the fact that we see pretty high rates of inflation in India?
Inflation means that it's a shortage economy. The shortage economy means there are bottlenecks, right? The bottlenecks, and the infrastructure is a serious bottleneck. I think that India still needs to have a physical plan. Now, don't emphasize kind of fiscal, the economic targets like GDP and so forth. Those targets not so meaningful in the long term. Still, India needs to have physical targets. Like how many if we're going to become like a $5,000 per capita income or $10,000 per capita income economy, what the economy should look like in terms of the cities, in infrastructure. Okay, how much time we have, so every year how much we should build. So at the end of every year, check what we have done, instead of like there's no need to look at the bank's balance sheet is expanded by so much, the GDP figure is this so much. These are things not less important for developing countries. Physical targets are a lot more important.
Have you been tracking the Indian banking story and what's happening with the Indian banking story? What do you make of it? There are concerns at this point in time on the public sector side.
Yeah, I think that there are bad loans. China had a lot of bad loans in 93, 94. The key for a country like India is that to focus on growth. There are always tons of problems out there. You must grow out of your problems. So it's focus on growth like a laser. All the other things like a banking system, monetary policy, fiscal policy, all come together to support growth. Okay, what is growth? Growth is investment. Okay, focus on then what is investment? A bunch of projects. So that becomes very concrete. You have a bunch of projects and all the resources, you mobilize the resources to make these projects happen. That's economic development.
Speaking of economic development, I know one of the ideas that you back is the development of special coastal zones.
Yes, right.
This is an idea that the government has been toying with but hasn't really moved very far. You were also a critic of the special economic zone idea that the previous Indian government had taken forward, because that essentially, to your mind, became about land grabbing. How important should it be for the government to prioritize coastal zones?
I think that the most important part is urbanization, right? Infrastructure part is to support that. And India definitely needs to build massive cities on a scale like China and no other countries have done. Basically, a city will have more than 40 million people, 50 million people. You need to do that in order for a country with 1.2 billion people to urbanize quickly, because urbanization must have economy of scale. For a low-income country, everything needs to be done cheaply, and the one way to do it cheaply is to have economy of scale. So we must draw up urbanization plans and how many cities that India should build. Right? China actually 20 years ago, 30 years, China didn't have a plan, but what they had was to empower these city governments that if you grow, you get rewarded. So some cities become very successful, like Shenzhen, from nothing to like over 20 million people, right? So lots of cities have now reaching like 20 million people. Still have a lot of upside. And the economic development, there's a lot of conflicting objectives. We need to look after poor people, and so there's a social equity issue. But the issue is the most important thing is to put people into the modern economy. So the economic development needs to be concentrated, actually, to have economy of scale. And in the short term, you're going to have a lot of difficulties with this approach because a lot of people don't see the benefit of that. But over time, people will see the benefit. So India really needs to have a plan, a physical plan. And economic development is mostly about construction. And so all this talk about finance, about internet, all those stuff, really, you cannot eat the internet, so you cannot live in internet. It's always just talk. People need to have a place to live, and people need to have a place to work. It's all physical, okay? So there must be physical plan.
ask you about what you see as being the big global risks. I mean, so far we've seen growth momentum for the global economy look pretty strong. The IMF as well as the World Bank both have got good forecasts for global growth. What could turn the party around?
Well, I think that the momentum is good, but the fundamentals are not so good. Yeah, you see the now trade is rising at about 4%, so it's higher than the GDP growth rate. So it means that the economy is pretty healthy. Growth is pretty healthy. But on the other hand, we see interest rates are too low, and the fiscal deficit too high. So it means that the growth we are seeing is supported by very unhealthy policies. So this is where I see that if the bond market is spooked, we have a global bond bubble, right? So bond yields are so low. It cannot be, because governments eventually don't pay their debts. No, eventually they borrow more and pay off borrow new money to pay off the old money. Eventually, all governments default. So I don't understand why interest rates are so low. If suddenly there's a bond market sell-off, the global growth can be derailed.
Would a bond market sell-off be your number one risk today?
Well, not short term, because central banks are coming to buy bonds. So they have a quantitative easing. They need to maybe to sell some bonds. They are talking about it. But if the bond market suddenly crashes, they come in to buy bonds. So this growth is really supported by these unusual policies. Eventually, I think the growth rate will come down because productivity is really low. We are not seeing productivity anywhere. In China, productivity has come down a lot. In the United States, productivity is very low now. So I think that the growth rate we're seeing now, there is a momentum, but it will taper off.
I'll end by asking you about employment. I mean, globally today, unemployment, is at almost a historic low. But in India, this is one of the key challenges that we're faced with. From a policy perspective, what to your mind would be the need of the hour?
Well, I think that now in the developed economies, workers have moved into the service sector, basically working at a Starbucks, so that kind of thing. They have a job, but they're not happy. That's why politics is pretty unstable. But in India, it's you need to look at the economic development as a huge long-term stimulus project, put people to work. So if you have building highways, cities, people have jobs. Then you pay them money. It's okay, because you say that you save the money to buy the properties you build. This is a virtuous cycle. See, that was the idea in the 1930s with Keynes building infrastructure spending. But now it's not appropriate for developing economies. But for emerging economy, that still works. It's economic development is like a huge Keynesian stimulus project.
The big risk for global growth. We're here in Russia. There is a possibility and a threat of further sanctions. There is, of course, the uncertainty with respect to the Iran deal. What to your mind could be the destabilizing factors?
I think these are really noises. The oil price now is getting close to $80. So,
you think that there's room for oil prices to move higher?
I think not much. I'm not in the camp that it's going back to $100. I don't, because China is not growing at 10%. China is growing at basically half as much. So I don't see that. This optimism about oil is unwarranted. I think $60 is more like a reasonable price, not $100. But I think that with oil price at this level, the unstable parts of the world are getting money. So I think that it's not going to be so stable, unstable. When the oil price crashes, then we need to worry about the instability. When the money is going around, I think it's going to be okay.
It's going to be okay. Andy Shea, it's always a pleasure. Appreciate you joining us here on CNBC TV 18, and thanks very much for your time.
Thanks.
With that, it is time for us to wrap up this CNBC TV 18 special. From all of us here, goodbye, and many thanks for watching.